because of the more down payment requirement, because of the low rates that we have all this time, people are sitting on a lot of equity in their homes. The average equity today twice more than it was 25, 30 years ago. So people have really great, the homeowners have great profiles. Will the 2008 financial and housing crash likely to occur today in 2026 or around? So first of all, let's go back to I would say 2005 to 2010. In 2005, everybody was saying, look, you know what, these lending standards are crazy. People are just, anybody can get a mortgage. But that lasted in 2006, 2007, and sometime in 2007 it was already showing real signs of a crack, that it's going to come down really hard. But it didn't really happen until the beginning of 2008, when we were really all hit so badly. But why? Number one, as I mentioned, the lending standards were really lax and bad. What I'm talking about, people could get into a home with no money down and with no documentation to present. No pay stubs, no tax returns, no credit. Sometimes even bad credit was acceptable. Sometimes no credit was acceptable. They didn't have to disclose their job. They didn't have to disclose their income. They didn't have to disclose the money that they have in the bank. Not all the banks did it, but a lot of banks. And the idea was the following, that Americans value their homes so much that no matter what, they're not going to default. That's what banks based it all on. But they made a mistake. A lot, or most of them, made a mistake. The system really crashed. And what happened? People weren't able to afford the payment, or sometimes they didn't even make any payments. They just kind of liked the system. They would get with no money down, had no intentions to pay. After a little bit, banks would start a foreclosure, would default them right away, would start a foreclosure, and it would just take time. Meanwhile, banks are losing money. Values of homes went down because now when the banks... So why did the values go down? Now then the banks realized that everything is, people are not paying. Now they started to tighten up the standards, and all of a sudden people didn't want to buy homes at the rate that they were buying, and house values plunged. Not to mention that first, because of those lax programs, the values really skyrocketed beyond reasonability. And the other thing was that a lot of people took either adjustable rate mortgages or mortgages with negative amortization, where if you, let's say, took out $100,000 each month, instead of going down, your mortgage balance would grow. So that's negative amortization. So when those rates really went up, there was another reason where people couldn't pay. Okay, please stay with us. We're going to talk about what is different now, and then we'll compare. So what's happening today? Today, the environment is obviously very different as far as the lending goes. When this happened, the government stepped in and they said to the banks, okay, no more. You're going to change your rules, or we're not going to save you anymore. This is like in general terms. This is when qualified mortgage came in, right after the crash. Maybe it was 2011. And one of the things that qualified mortgage, one of the definitions, how to get that definition addressed by the banks, was what's called an ability to repay. Banks now need to make sure that you are able to make the payments back to the bank, okay? And so that's number one. Number two, with alternative programs where you don't have to show tax returns, they still exist. They didn't disappear forever. They did disappear for a little bit, but then they came back modified, much better in my opinion. No income, no problem, but you need to put more down payment. If you're not showing us tax returns or pay stubs and you plan to put 5% down, sorry, we're not doing it. You want to put 10% down? Sorry, we're not doing it. You need to put more, maybe 15, 20, 25. The more the better. And I love it because I personally look at some studies where people who default the most are the people who put less money down. Because they I know this is like a cliche expression, skin in the game, but it really means something here. When people put, let's say, $100,000 down on a $500,000 home, which is 20%, boy, they don't want to lose that money. Even if the house value goes down for a little bit and then goes up again, they're not worried. They just continue paying because they are thinking that it was hard earned and saved this 100,000. We are not going to just leave the house and let it die. So it forces people to make that payment. Plus, the banks are looking at it from a different angle as well. If you're able to save 100,000, then you're better with money. That's how they look at it. I do want to mention that 3.5%, 3%, 5% programs, they do still exist, but only with full income verification, where you need to show your tax returns, your pay stubs, your W-2s if you're self-employed, your business tax returns, and then we do the calculations based on that. That's always the best case rate-wise, but not everybody is in that category. So moving on, the lending standards are a lot stricter these days. And the other factor, because it was kind of slow growth over these years. So you see, if the house prices went really, the increase in house prices went really high between the years of 2003 to 2008, between the years of 2010 to 2020, it was a slow moving increase. Prices they increased on average in America, but they didn't go skyrocketing high every year. So it was slow but steady, and over time it makes a difference. So why am I saying all of this to you? Today, because of the more down payment requirement, because of the low rates that we have all this time, people are sitting on a lot of equity in their homes. The average equity today twice more than it was 25, 30 years ago. So people have homeowners have great profiles. And in case they cannot pay for a mortgage, so I'll give you an example. Let's say somebody has $1 million home and the mortgage is for $150,000, but he cannot make a payment, okay? Lost their job or, different situation. So instead of defaulting, person can sell the house. Person can pull money against the house, if they qualify. So what I'm trying to say that there are options today that they will not just walk out. That's why, and that made the profile and the situation generally in housing in the United States much better compared to then. Now, do we have issues today? There are any economical concerns? Of course they are. So about that in our next section. So today, not everything is perfect. We have rising energy costs. We have, obviously the war in the Middle East with Iran, and that's related to the rising costs for energy because obviously supply of the oil in the marketplace is lower. The Strait of Hormuz is still closed. So that drives prices up. And it's not just, you are getting gas at the gas station. It translates to pretty much every sector of the economy. The transportation cost is higher. So to move, big deliveries of lumber or food, groceries, obviously costs a lot more, and it is affecting the end consumer. We also have, because of this, we have rising interest rates. We're sitting today in the middle of May of 2026. 3 months ago, mortgage rates were much lower than today. So obviously that affects the affordability. So situation is not perfect, but it's very far from that destabilizing and very unfortunate situation in 2007, 2008. So summarizing all of this, I do not think we're facing a crash. We might get a correction at some point or not. Corrections, by the way, are very inherent to any developed economy. We might see a small correction in prices, which we have seen after 2022 already in many places in America. One other thing that I wanted to also mention is that the demand for housing is still very high in America. I think we have more people who want to buy homes than available homes. So there's still a supply shortage in general terms. So summarizing all of this, I do not think we are facing a financial crisis of 2008 style. And I'd like to hear your input. Please comment, like this video, share with your loved ones, and we'll see you soon again.